Hey guys, Greg Secker here. Well, listen, we are back in the trading den. It is raining. It is Great Britain in March. And today we are hitting one of the most important indicators. This is the mother lode. This is the indicator that professional traders use and baby beginners know nothing about. It is known as the ATR indicator. We're going to be covering it right here, right now. Okay, so what do we use the ATR indicator for? First off, let's go through the benefits of this little known indicator used by, let's be honest, successful, consistent, professional, successful currency traders. Beginners spend their time looking at RSI stochastics, MACD, or otherwise known as MACD, and a whole host of other indicators. And whilst they are important, nothing, and I mean nothing, has the value of the ATR indicator. So today on the channel, we're going to cover that first. So what do we use it for? Well, the ATR indicator is used to identify really explosive trends that are about to break out. In other words, it's a great indicator for knowing where it stands for the average true range of what? Well, the average true range of volatility, of price range movements. And we really need to identify multi-year lows in terms of volatility on the ATR or on a weekly period. And if the weekly ATR or that average true range is at a multi-year low value, meaning that the price range movement has gotten quite quiet over a long 12-month period, it means something big is about to happen, as the Forex market, as we know, does not stay quiet for long. Let's jump into the screen, take a look. So I'm going to look at euro dollar right now. I've got a really basic vanilla chart. As we know, euro dollar is the most traded currency pair, so this will bear the most truth to my prevailing statement. First of all, let me show you how you add the ATR indicator in Smart Chart. So we go across here to indicator. If you can't find it, you just type in ATR and it will find the average true range. Nice rapid search function there in Smart Charts. So I bring up average true range, I click on that, and it populates it straight into the window. Now, if I want to change any of the settings on the ATR, I would literally move my mouse over to where it says ATR, and it'll pop up a small window. I can change all my parameters here. I can change the number of periods. The period setting we want to use is 10. So here's what we're going to use, ATR 10. We're going to look over a 1 year period. So I click on 1 year down here, which now it means it brings the whole year's worth of data into the window. I'm looking at a daily chart. Now, notice, when the ATR first of all loads on, it will look something like this. I want to now stretch this up so we can see where the peaks and troughs of the indicator are. And the point I made was that when we are at a multi-year low value, so let me show you where the multi-year low value is. Again, I'm going to go to one of my tools, highlight where the multi-year low is. So if I click on drawing and arrow icon, that's the one I want. And I'm going to point to it very clearly on the chart so you can see where the lowest point of the year was. Now I'm going to drag the indicator down so we can focus more on the chart. And this point here correlates, as you can see, from this low point of the arrow, correlates to around here. And if we then look at what happened, so this is when the volatility flattened right out at the multi-year low. We then can draw a price range movement, so we can measure price from that range, which is around here. And we can see from this movement here, we had a small rally and then it gets going and you've got about a 250 odd pip movement from that low volatility point. So what that really tells us is that volatility is really flattened out. Now it's got to the low point and generally something is about to happen after you get to that low point. You can certainly see here, after we got to that lowest point, it would then break out and we get the volatility moving again. That's what happens in the currency markets. There's always an ebbing and flowing between low volatility periods of time and higher volatility periods of time. So that's the first use of the ATR indicator, not the most common use, but one of the first uses to show you when volatility is getting low. We plot that on a daily chart. So the first thing we did was we select daily. Then we hit the 1 year button. That gives us a year's worth of data. Every bar on the chart is equivalent to one trading day, one 24-hour period of trading data. Then we added the ATR, that's the average true range. That gives us the average of price range movement over a period of 10 days. So it looks as a moving feast of 10 days and it plots a curve as it has done here. We look at then the low point over that 12-year period or that rolling 12-year period. And at the low point, we're then looking for the market to get moving and create an explosive trend, which indeed, look at the trend, up, down, up, down, up, down, up, down. So it's an explosive trend as per the prevailing comment. So that's the first use. Now let's have a look at another use of the average true range indicator. We're really going to use it to predict market turning points and identify high probability trend reversals. Now the market only has a certain average amount of potential energy in any one week. So we use this knowledge to our advantage by looking for a market that has moved more than 1.5 times, so the market structure itself. If it's moved 1.5 times more than the ATR, we then expect a reversal to have happened. So let's go and have a look at that. So let's have a look at what's been happening more recently. And I'm going to look here at actually measuring the ATR. So we notice here, now here is a market which has reversed. I'm going to use this as an example. So take a look at where the ATR currently is now. So let's have a look where the so let's say markets has moved quite steadily up to this point. So if we measure the price range from, say, take this little trend movement up here, then we had the market fall away here. So let's take a measurement of price between, say, this area here and this area here. And we've got about 240 pips, let's say, in terms of this upward movement, this short-term trend over the last few months, let's say. Now watch, so I take the same box and I see that the market's 42 pips as it's moving up. We're now at 51 pips. And now we are at 47 pips. Yet the market over this period of time has moved in excess of 245 pips over this period of time. So effectively what you're seeing is that, and this obviously is indicated by this big jump of price movement here, the market is well in excess of 1.5 times the ATR. So if I just take, even if I take a single point in time, take these last week in time, this is a great way of looking at just a week of data. So take, for example, here we're looking at a range of 50 pips right down to about 46 pips. So 50 to 46 pips, 1.5 times that would be, 90 to maybe 100 pips. That would be double. So 1.5 times would be sort of 80. Now look at the price range movement here. We've got well in excess of that 243 pips. We then top out, then the market reverses and changes direction. So what we're noticing here is that when the price moves in excess, in other words, we've got an expansion of price range movement, which is at least 1.5 times, or here it's over 4 times, 5 times greater, then we expect a decent market correction. So when the ATR range is magnified 1.5 to 2 times even by price, we expect a correction. We then see that correction play out only a day or two later, and then the market starts to move. So that's a classic turning point. So a couple of recaps there. We've looked at the ATR for telling us when an explosive trend is likely to happen. We've also looked at when a turning point in the market's likely to happen. Let me show you another use of the ATR, which is critically important. Now, look, we can use the ATR, and this is probably one of the most important uses of the ATR possible. This is about setting up a proper stop loss so you live more of a lifestyle trader than being like everyone else that gets stop hunted. Now, stop hunted means people who set their stop losses way too close to resistance levels or way too close to below support levels. It's highly used. It's very stupid. Different markets, of course, have different volatilities. And so I'm going to just jump on the screen right now and give you an example of how just by only using just price action alone with support and resistance areas is a kind of a dumb mistake. Let's take a look at the chart I'm on right now. And I'm going to draw in by freehand a line of resistance. I'm going to say if the line breaks above this line of resistance, I'm looking to go long, let's say. However, I need a stop loss in as well. So let's say my stop loss is going to be along this horizontal line here where there's price. Let me just move that to right place. Let me just see if I can draw this in different colors just to make it really clear. So I'm going to say that support is going to be down there at green. This is going to be my resistance line up here at red. That's what I'm saying is I'm looking to buy above here. Okay, so let me just kind of annotate that for you as well. If I put in a little bit of text. Let me see if I can put in a little text box for you. Here's some notes. That's what I'm looking for. A note balloon. So let's say I'm looking to, I'm buying above the red line. Let's just add that in. That's my breakout above resistance. Classic idea. And I'm just going to move that down here so we can see that's my intention, is buying above the red line. Should price get through? But I want to make sure I put a stop loss in. So the average guy or girl is going to put their stop loss in somewhere around here. Let me see if I can kind of make a little annotation of that for you on the chart to give you an understanding. So that would be somewhere, just below, let's say they put somewhere there, somewhere just below where the support line is. So we want to buy as it breaks above the resistance. We want to put our stop loss just below support. Now, the point here is we don't want to use a fixed stop loss. First, let's identify the market structure. This here is the market structure. It's a breakout. It's what we're looking at placing. It's a long breakout on euro dollar. And then set our stops away from the support, but give it the breadth of what the current ATR is. This is if we now look here, let me change this grab tool, which allows me to move the chart around, to a crosshair tool, which allows me to read the values on the chart. And I now move my crosshair down to this. And it says, well, look, Greg, if you look here, my volatility at this time is like 14, maybe 10, 14 pips away. So my market is moving around 14 pips at the moment. So if my stop loss is down here, which effectively is like a point or two away from where this support line is, the probability that I could get stopped. So I'm going to say where this squiggle is where the average person might put their stop loss. I'm actually I've read off here that it says, look, around this time here, my ATR 15 to maybe 12. So I'm going to say like maybe my ATR should be 12 to 14 points. Give it some breathing room. So I'm going to measure where that is on the chart just to show you how powerful this is. And I'm going to go from the bottom here and I'm going to say, okay, I'm going to give it the breathing room of maybe 12 or 13 pips like that. So my real stop loss using the ATR should be at the bottom of this blue line, because I've used the ATR to give me an indication of how much market is moving around in this market structure. And so I'm now going to draw another horizontal line, and this one I'm going to put right at the bottom here, and I'm going to say, okay, this is the yellow line is where my intelligent stop loss should go. Now let's play the market out and see what happens. So your average guy or girl puts their stop loss just below the level of support because they think this is where it should go, just below that. Let me just give it a couple of pips. The intelligent person uses the ATR 10 and says, no, it should be this amount of movement. Now let's move along and you'll notice, look, this person easily got stopped out. And this is a classic. If we'd have placed our stop loss by licking our finger and sticking it in the air, which is what 90% of currency traders do, beginners, intermediate, and those who call themselves professional, they're literally just putting their stop just behind a support resistance level. We don't want to use a fixed stop. We first identify the market structure. Then we set our stops away from it using the ATR. Set the stops away from the market structure because the ATR can help with keeping you profitable through what are quite volatile and changing market conditions. Note on this example here, we would have quickly and easily got stopped out where the average person would have put their blue line, but we've put ours on the yellow. It's kept us safe, done exactly what it should do, and therefore ensured that we can then ride out the position, get ourselves then into a profitable trade, and we can get moving from there. So that is critically important to realize that the ATR's most prominent use and most powerful use is knowing where to place your stop loss. We use the ATR to ride massive trends without getting stopped out on these minor retracements. So we're using a volatility-based trailing stop loss, and that's a multiple of the ATR to avoid this common and widespread example. Let me show you an example of that. So if I jump onto, for example, smart charts right now, and I've got my buy and my sell, but let's just say I hit my buy button. Let's go to, let me just go to where the current price is, hit auto scale. And let's say we were looking for some reason we wanted to get long in the market. Let's say we decide to get long in the market here, which says a buy entry here. Let's say a stop loss. It's suggesting a 20 pip stop loss. It doesn't mean place a 20 pip stop loss. It's saying, 20 pip stop loss is suggested. Now, given you're just placing a no strategy at market trade where do you want to put your stop loss? Well, a great idea here would be to use the ATR 10 again. So I'm using my crosshairs. I'm now dropping my crosshairs down to here. What does ATR say? It says, well, you should at least have 18 pips away from where your current market price is. It's 20 pips away. I'm certainly within my ATR. So if I want to ride a bigger movement, no one talks about a guideline of multiples for the ATR. And so to guide you, think of it like this. If I want to just jump in and grab some profit, great. 20 pips on current market volatility, this is fine. But if I really want to ride a much bigger, a much more medium-term trend, then I want to be thinking, the golden number here is 3. So my stop loss wants to be 3 times my current ATR. My current ATR right now is 1819. Yeah, 18 pips, if you can read that on the scale there on the ATR 10. So 3 times 18 is what? 54 pips, I suppose, would be the answer I'm looking for. So 54 pips away from where current market price is. So I could set this down. I could literally just drop this down here. As I move this all the way down to 54 pips away, and it's done it. Now it knows how much risk I'm taking. Now, obviously, I can move my profit target down. I can change the whole dynamic of this. But I now know that for a much larger trend, or at least a medium-term trend, 3 times current ATR is going to give me equidistant away to ensure that I can then ride that movement. Again, I'm using the ATR then just to allow myself access to a much more explosive growth. If I want something much more long-term, the magic number we're looking for is 5. So under current market conditions, that being 18, we're looking at a 90 pip distance from the stop loss to the current price, or at least where our stop loss should be placed. And all we're doing is we're multiplying 5 by current ATR, which is 18. So 90 to 100 pips away ensures that we can then ride a much longer term trend. So we're using the ATR. Remember, the ATR indicators does not tell you the direction of the trend. It's certainly not a trend indicator. It moving up doesn't mean market's going up. It just means that the open and closing price are getting further apart. It means that there is more confidence in that direction. If where open and closing prices are closer together, it means there is disagreement, or it means there is a lack of confidence in that direction. When an opening price and a closing price are further apart, it means volatility is increased. It means there is confidence in that direction up and confidence in that direction down. Now, a huge point to take here is that if the market has moved more than twice the ATR into an area of support resistance, it could snap back in the opposite direction. And that essentially means you're in that expansive phase of a breakout where the open and the close price indicated by the ATR is at least twice the ATR, which means that you are looking to hit an area of exhaustion. So let's have a quick recap. First of all, what do we use the average true range, that ATR indicator for? The identification of explosive trends. We use it to predict market turning points and, most importantly, set an intelligent, not a stupid one, an intelligent stop loss. Avoid getting stop hunted. That's the last thing we want. Ride medium to massive term trends. And remember, it's not a trend indicator. If you like this video, don't forget to hit like. If you're not a subscriber already, don't forget to get yourself on the subscription list. And if you check the link in the description of this video, you'll have access as one of my YouTube subscribers to get yourself a copy of Smart Charts.